The NEOS suite of high-income ETFs aim to offer investors reliable, tax-efficient monthly income and the potential for upside appreciation when their underlying indexes rise. What exactly does this mean, and how do they work? NEOS high-income ETFs offer exposure to some of the largest U.S. indexes like the S&P 500, NASDAQ 100, and Russell 2000, overlaid with a data-driven call option strategy that aims to provide tax-efficient monthly income distributions to its shareholders. These monthly distributions can be comprised of option premiums, equity dividends, and long-term capital gains. NEOS high-income ETFs also seek to participate in a portion of the respective index's appreciation in rising markets to help investors pursue a compelling total return, in addition to the primary objective of distributing tax-efficient monthly income. First, let's talk about how the call option strategy works. Each month, the NEOS high-income ETFs sell laddered index call options on their respective indexes to generate premium. The premiums received by the ETFs are then largely used to fund the distributions paid to shareholders each month. Their data-driven option models have mechanisms that seek to allow the underlying portfolio to appreciate when their underlying index rises. Those can include selling call options that are out of the money above the current price of the underlying index, not covering the entire equity portfolio with written call options to leave a portion of the equity securities uncapped, and in some cases, when indicated by our rules-based model, purchasing an out-of-the-money index call option that may offer upside exposure. Why utilize index options to generate premium? What's unique about index options is their classification as Section 1256 contracts from the IRS, which enables them to receive 60% long-term, 40% short-term capital gains taxation, regardless of the holding period. This is different than equity dividends, single stock or ETFs options, equity-linked notes, swap contracts, and interest payments, which can be taxed as ordinary income based on an investor's tax bracket. Monthly distributions from the NEOS high-income ETFs have mainly consisted of return of capital, which can be a scary and misunderstood concept. Here's why. Historically, return of capital may have been thought of negatively, specifically for investment funds that offered regularly scheduled distribution payments to their investors but didn't generate enough returns to fund those payments. The result, an erosion of an investor's original principal and a destructive return of capital. But return of capital can offer an added layer of tax efficiency to investors. Return of capital distributions are not taxable in the year they're received because, according to the IRS, it's a payment that's not considered income nor capital gains from an investment. How does NEOS aim to utilize the tax efficiencies of return of capital in our ETF's monthly distributions? The experienced portfolio management team at NEOS Investments are pioneers in the options-based ETF space with decades of combined experience. They aim to find gains in each ETF's portfolio, whether that be from the call option strategy or the long equity positions, that they can pair with a portfolio loss to classify a portion of the monthly distributions as a return of capital for tax purposes. Additionally, the ETF structure allows portfolio losses to be indefinitely carried forward, which also allows the NEOS portfolio management team to harvest losses at opportune times to offset gains, either in the option portfolio or the equity portfolio. Okay, so NEOS high-income ETFs aim to receive the tax efficiencies of return of capital, but what about the risk of principal erosion over time? As mentioned earlier, the ETFs aims to capture a portion of the upside appreciation in the underlying indexes, so that an investor's principal grows over time, and therefore they're not actually receiving their original investment back, but rather a tax-efficient way to seek monthly income with long-term capital appreciation potential. It's important to note that these monthly distributions will reduce an investor's cost basis over time, offering long-term capital gains treatment if and when an investor may decide to sell their shares. What does all this mean in summary? NEOS high-income ETFs aim to offer investors a way to seek reliable monthly distributions that may receive a favorable tax classification via return of capital, and index options classified as Section 1256 contracts. They also may offer upside potential so that our investors won't be subject to principal erosion, also known as a destructive return of capital. We want our investors to receive a monthly distribution on a growing investment value, rather than eroding their original investment value from a distribution program that doesn't generate enough returns to fund it. How can you learn about how return of capital pertains to your specific tax situation? Yearly tax classifications for the distributions from all NEOS ETFs are reported via 1099 forms from each investor's brokerage, making it a convenient and consolidated way to view the distribution classifications. Investors can also check the NEOS ETF fund pages on our website for monthly tax estimates available via 19A-1 forms, which can be useful for planning purposes. It's always important to consult your tax expert because every individual's situation is unique.